So, affectionately known by your colleagues and friend as Bill 4, we're speaking with Bill Miller IV, who is the son of, would we say, Bill 3? See, I'm a pretty smart guy. I've been in the institutional business for about 30 years and managing money, but also advising other portfolio managers. And so I've had the great fortune of working with some of the great fundamental oriented managers, both on the growth side and on the value side. And what I have found, just as a technician my entire career, I have found that the ideas that I generate vis-a-vis the technical process just really, really resonate well with growth-oriented managers. And I always struggle to find that similar overlap with value managers. Typically, when a stock is really cheap, the chart, it doesn't look great in the trend following perspective. Maybe on a mean reverting perspective, whatever, it might look okay. But I struggle to get value managers to embrace trend following oriented ideas. So here we are. We're sitting here speaking with Bill 4. He's a devout value manager. And somewhere along the line, you thought about your process and you said, there's something missing here. I need to fill the gap. And that's, by the way, that's the point of the name of the podcast, Fill the Gap. And so somewhere along the line, you said, I'm going to get my CMT. Can you talk to us about that? What got you to get your CMT, and then maybe a little bit about how you do use it?
Sure. So I actually graduated business school in 2008, spent a lot of time in financial classes, trying to figure out the market, how it all works, how it fits together. After graduating, ended up going to work with my dad's firm, obviously fundamental value manager. And along the way, we started this income strategy that I now run. And
that's a mutual fund? Is it a private fund? Or?
It is. It's a 40 Act fund.
40 Act fund.
It's a go anywhere. The whole idea is a high level of income, and so we're looking to buy undervalued yield is kind of the premise there. But so in working on that portfolio and employing a lot of what I learned at business school, I then did the CFA right after business school, got that done in 2011, and rigorously applying those principles to the market, securities with yield, bonds, up and down the capital structure.
Yeah.
I felt like something wasn't working, and a lot of the time there, we can talk about the Fed regime and all kinds of other stuff, but
we will.
Things just weren't working, and I was sitting here going, this is clearly too cheap. Every piece of fundamental theoretical work will tell you this is too cheap. What am I missing here? And the more you dig into Bloomberg and the more time you spend in the financial services industry, you realize there's a lot of different ways to skin the cat. People look at the market from so many different perspectives. The marginal trader is not necessarily me. It's not at all, actually. And one of the things my dad's really well known for is coming at a problem from a variety of new perspectives is really valuable. And I was missing this entire set of perspectives that a huge part of the market was employing. And so you're at a massive disadvantage if you don't understand these types of things. Mm-hmm. You're only looking at it from one angle. So I realized I got to check this out. Found the CMT online and took the test, and here we are.
And I know one of the things I always appreciated, I'm a huge fan of your dad's. I've followed his success through the years, and I know that he's a very open-minded investor, so he would engage in these think groups that just really try to expand the way you think about things, science, and just bringing all these disciplines into your thought process so that you can have as holistic a decision-making process as possible. And so I would think even somebody like that, who's that open-minded, and his son comes to him and says, "Hey, Dad, I want to get my CMT." What did he say about that? Was he that holistic?
No, he said, absolutely, you should do that.
Great. Okay.
He actually used a lot of technical analysis himself, although he's...
Are we recording this? Did we just hear what he just said?
Well, no, here's an example. So the main sheet that he uses to look at his portfolio every single day, it's called a daily performance report. And it's got every single position ranked by weight. Okay, so the first stock, second stock by weight. And then, it has stock price, it has size of the position, percent size. And then right next to that, which is what matters, is performance yesterday, performance last week, performance last month, performance last quarter, performance last year, trailing year. So it's all these performance statistics of each position relative to each other in the portfolio. And then above that, we got commodity A, SPX, small cap. But so we're looking at this stuff regularly. And I never would have thought of that as technical analysis. That's exactly what that is.
Sure, yeah.
So
that's momentum.
And I think people also make too much of a distinction between fundamental and technical analysis a lot of the time, because what we're all trying to do is just recognize patterns. And so we use different toolkits to recognize those patterns. And fundamental guys are looking at the actual cash flows, generally speaking, of the firm and the prospects for those and discount rates and things like that. And technical guys are looking at other things. But there's one of the things that's taught in the CMT that is just danced around in the CFA is insider behavior. And we look at that extensively. Just because when you invest, you're investing with people. It's important to know what those people are doing and thinking. We look at the context around insider activity. And we think about that. That's one of the highest signal value things I think out there. I think it's probably still underutilized, broadly speaking. So that's a CMT thing, and it's not really touched upon in the CFA, but it matters immensely.
Right. Before we get too further down the discussion of how you think about markets and whatnot, I wanted to ask you, one of my favorite questions with Tyler is to ask of a guest is, who were your early influencers, and perhaps what books have you read? And in your case, it seems like a silly question to ask, but I'm going to ask anyway, just because I guess maybe the proper, different way to phrase it for you in particular was, what was it like growing up with Bill 3 at the dinner table? Was it sports, or was it how to buy value stocks?
It was a lot of sports.
Yeah.
It was a lot of him also getting upset about people doing dumb stuff and not employing like rigorous thinking and goal-based analysis, or actually using evidence to connect
right.
Ideas to actions. And so that's one thing I think he's done really, really well, is just being relentlessly evidence-based. And that's an important thing I've taken away from that. From an influence perspective, I think one of the best books out there, I can go through a whole bunch, but The Psychology of Money by Morgan Housel.
Yeah, that's a great book.
That's such a good book.
My son actually sent me a copy of that.
It's so good. All the lessons in there are just timeless and so well distilled too. And so I think a lot of those things are things that I've learned over the years, but never seen them distilled in that way in such a concise format. That
yeah, and I just thought this is not an advertisement for Morgan, but his I guess we still call it a blog these days, but he writes a fantastic blog, and it's very thought-provoking. It's sort of like a Michael Mauboussin in the way he writes and thinks about the world. It's just really refreshing, and again, it's just pulling your mind in different directions to get you to think differently.
Yeah, and Michael is so good about differentiating process and outcome. You can have a really good process and a bad outcome, and vice versa, and it's important to keep that in mind.
Exactly, yeah. We had an opportunity briefly a couple times to just get to know each other a little bit better before today's discussion, and one of the things you had mentioned was, and I can't remember if you said it was when you were at Miller Value Partners or just before you joined, where they had done an analysis of your holdings. And can you talk about that? Because I just think that's just incredibly refreshing, but it's also, I think this audience in particular would really love to hear the story.
Yeah, it's powerful. It goes back to the first question. I should have mentioned it then. But with regard to value and employing technicals as a value manager, they had a third party take a look at the history of the Opportunity Trust and how they could have improved their own behavior. And what the third party found was, if they had just waited until their picks went above the 50-day moving average, they would have cut off a ton of downside, volatility. So, not obviously, but they were identifying things that were cheap and inexpensive. But the reality was they could keep getting more inexpensive. And by just employing that kind of behavioral hack on themselves, you could have, improved your IRR significantly.
Yeah, and that's one of the main things that I've seen. Fundamentally oriented portfolio managers benefit from technicals many ways. One of the great things about technicals is that it's scalable. So I can't remember who said it, but the quote was, "I can look at 1,000 charts in about an hour. How long do you think it would take me to look at 1,000 balance sheets?" So that's the scalability of technical, so it helps you with that. But where I have seen it most benefit fundamental investors, it is on the risk side. So most fundamental managers have their style, they have their strategy, they know what they want to own, they know how to execute their process, but what they don't know is when they're wrong. And what you just highlighted is a perfect real-time example of how one of the best fundamental managers who's ever lived. Show of hands, who knows who Bill Miller is? You've heard of him? So why don't you introduce your dad? You do it way better than me, I'm sure.
His claim to fame is outperforming the S&P for, I think, 15 consecutive years.
Yeah, which is, do it 1 year is tough. 15 years in a row is so he's clearly in the top echelon of money managers of all time. Here's one guy who's of that caliber adopting technicals in a very rudimentary, very, very simple way, but it's very, very powerful and very effective. And that's actually, of all the fundamental managers I've ever seen incorporate technicals into their process, it's almost invariably that's the most impactful way, is that they just have a column in their spreadsheet that delineates between good and bad trend, and no matter how much they like the stock, they can't buy it or they can't at least make it a big position until the market agrees with them, right?
That's right.
Yeah. So in that vein, what happens in a portfolio that you're managing where you've got your fundamental thesis, you think everything's going great, you just had the earnings call and you liked what you heard, but the chart in a meaningful enough time frame, like the short-term charts, as Charles Dow said all the way back to the early 1900s, short-term charts are driven by emotions and fears, long-term charts are driven by fundamentals. So I'm assuming you're looking at longer-term charts, you're not looking at the hourly chart and daily chart. So you're looking at the monthly chart, say for instance, or the weekly chart, and it actually inflects trend, and it goes below the 200-day average, and the 200-day average starts going lower. But in your mind, you just got off the earnings call, you liked what you heard. What do you do with that disconnect? Do you actually respond to that, or do you obviously you sharpen your pencil, but what else? What do? Do you take action?
Someone on the last panel made a point that you need to know what you're looking at before you actually go into the position, and that's incredibly important, to be intellectually honest with yourself and say, okay, here's the thesis, here's the 3 or 4 things we're betting on, here's the signpost to look for if we're going to be wrong moving forward, and it depends on what was said during the call and how that relates to your thesis, right? And if it was one of those things, you need to start thinking carefully about, changing the thesis or getting out of it. If it's not, there's obviously also an offset to that move too, and that when something moves lower, the valuation changes at the same time. And so you then have to triangulate all of those things together. But it goes back to originally saying, okay, this is what would make me wrong. Mm-hmm. This is what I need to watch for. And if it's one of those things, and it's still even hard when you know that. You just say, this was what I was looking for, this was the problem, and then getting out. Still pulling the trigger on that can be pretty tough.
Right. Yeah, and so you could say, though, that if you went through that review process and you still came away thinking you like the story and everything's fine, would you or would you not take action if you could clearly see in a meaningful enough time frame that this chart is broken?
I'd love to say I would, but I know from evidence that I don't always do it. So, it's tough.
Yeah.
I don't think we'd ever do something purely for a technical reason. And one of the lessons for me from the CMT exam and curriculum was nothing works in isolation. Mm-hmm. And but the more stuff you have in your favor from a technical perspective, the more likely it is to work. And I think you can apply that more broadly to any stock or security, which actually it represents a set of attributes. The more attributes that are in your favor for that security, the better it is. So you want to see it both technically working, right? You want it to be good technically. You also want it to be fundamentally inexpensive, and if you also have this insider activity. So the more things you can layer on it, it's almost like a quantum mental approach in a way. Mm-hmm. Yeah. But it has to do with just making sure there's more things in your favor.
Right.
To maximize your odds.
Right. It's kind of like the way Ted Williams broke up the strike zone. He broke it down into, I don't know, 64 squares or something, and he knew his batting average in every single one of those squares. And if the ball was in a square where he knew his batting average was 180, he wouldn't swing. Right. But if he knew that his batting average was 490 in this specific square, he'd swing. And that's just making sure that the pitch is in your favor and your skill set.
We're baseball fans, and one of the things that's funny about that chart is if you look in the chart, it's a great chart, by the way. There's
The Science of Hitting, right?
The Science of Hitting. It's a phenomenal book.
Great book for trend followers and investors to read.
It is. And if you look in that chart, there's only like somebody that once asked Ted, they knew Ted, they said, hey Ted, how come you hit 400 this year, but when I look in that chart, there's only like 3 balls that are 400? He said, yeah, I only swung at those 3 pitches.
Yeah. The reason I was asking about the, there's a certain and clear deterioration on a chart that's, again, in a meaningful time frame, so it's driven by fundamentals and it's deteriorating. You joined the firm in 2009?
08, yeah.
08. So were you there during the global financial crisis?
I was.
Yeah. So that's what I always thought was, we didn't call the crash or anything. We had no idea what was coming, but when you looked at the magnitude of trend deterioration in weekly and monthly charts, it was clear something was bad. I mean, you could tell that it was once in a generation type of deterioration. So in our portfolios, we didn't go to cash because we were bearish. We went to cash because the process was break a trend, sell that stock. Okay, let's redeploy the cash into another trend. And there were no other trends, so that cash just stayed. And then just wash, rinse, repeat. And before, I think it was probably August or so, or June or July, we were 100% cash. And I think a lot of technicians can relay a similar story in that period because we just follow trend and we find out the fundamental reasons later. So I would be curious to know if there were any lessons from 2008 that you've learned, you and your partners at the firm have learned that you've used and utilized to change your process and make you more aware of that potential left tail risk where this does happen. I think, I can't remember who it was, but who said it recently, but those types of events have happened 3 times in the last 20 years. So they're supposed to happen once every 100 years, but they seem to have a high recurrence. So
yeah, they keep coming up, but the market's still goes higher, doesn't it?
Yeah, it's also efficient.
So it's an important point to keep in mind.
That is true. That is fair.
Your process. It's important to think about the whys in your process and to think about how they all holistically fit into what you're doing. And so, it's really hard for us, and I think most people, if they're intellectually honest with themselves, to call these big drawdowns.
Yeah.
Just by definition, they're rare. The reality is the world tends to get better over time, tends to improve itself. People like to work together, but the world you want to be optimistic. And so trying to predict these big, unique events is challenging, and I know the charts sometimes point to it and you get out and that's great and congratulations, but they also, it's the bond market's called 20 of the past 10 recessions.
Yeah.
So if you do that and you go to cash, you then have to get back in at the right time. And so it also creates tax liabilities. The only thing when you sell a heavily appreciated security is you create a liability for yourself. And you have an outflow then, you have to pay the government. And you just have to think carefully about your process and how it all fits in. So we don't try and actively time these things for the reasons I just mentioned. We try and bet on success. Somebody mentioned yesterday, the economy grows. I mean, the stocks go up 70% of the time. That's exactly right. And they go higher over time, and you need to think about your process, and we tend to bet on that.
Yeah, yeah. Maybe you can take a little bit of time and just detail as much as you're comfortable doing your process, and tell us about your portfolio, what you're looking for, a little bit more about the strategy and your philosophy.
Sure. So the particular strategy was founded in 2009, actually.
Yeah.
In the depths of the financial crisis, when we looked around and saw high yield debt yielding 25%, and that's what that market was trading at. And we said, well, look, if this stuff doesn't work, no one's going to have a job, and we're going to be in a Mad Max kind of scenario anyway, so good time to start a strategy like this. And even if spreads didn't recover that year, they'd eventually recover, and we'd clip a really nice income stream in the interim. And the idea was equity-like returns at a higher level in the capital structure. That's still the idea, but we can go up and down the capital structure, go anywhere in the world.
You don't go short, just long.
We don't go short, no. Shorting is such a hard thing to do, again, because stocks tend to go up most of the time. But yeah, that's it. High level of yield. We go up and down the capital structure. We take concentrated positions, and we sell when we think the market agrees with us, or our position on the security changes, or we find something else better to buy. But we're the largest investors in all of our strategies and funds. We're a huge portion of that fund personally.
Yeah. And it's clearly, you're focused on yield, which tends to have a very high overlap with value in general, right? So you would call it a value fund, or you just more like think about it as being an income fund that happens to traffic in value-oriented names?
I'd characterize it as the latter. So, I mean, 30% of it's in debt right now. This is not your father's fixed income portfolio. One of our biggest debt positions is the unsecured debt of Endo Pharmaceuticals, trading at 44 cents on the dollar now, just because we've done the valuation work and we've looked at the liability that we think that'll eventually be there, and we think they're ultimately worth par. Now they're moving against us, right? So that's something that we obviously need to consider. One of the things also that the CMT has taught me is just the immense amount of knowledge tied up in security prices and being able to use that to your own advantage. So one of the things I love to do is look across markets and say, okay, where are the discrepancies that don't make sense? So we're buying now the equity of a building materials company in Europe whose long-term debt yields 2.8%. I don't know why anyone would ever buy that, by the way. But long-term debt yields 2.8%, and the free cash flow yield to the equity is 11.5%. And so that's a pretty interesting discrepancy, right? Like, why is there that difference? Something's probably going to break, as someone would say, and
right.
Something's got to give. And when you do the actual fundamental work on it, it looks like the equity is where it's mispriced. Chart's not great, but management owns 25%. They're buying shares every single day in the open market. Management just bought 20 million euros worth of the stock. That's all technical right there. Right?
Yeah.
And trades at 4 times EBITDA. I think it's worth 50 to 60% more than where it trades today. So.
Right. So I want to run something by you that is sort of a philosophy I've held to for a while, and it's probably influenced by Frank Texera, who's my former boss and very good friend today. And we talk about this often. I think we actually talked about it last night over drinks, but it's my belief that value actually doesn't work, and it's never worked. Hear me out.
Yeah, no, I'm not going to disagree with that statement.
And so it's not like value stocks don't go up because they're cheap. They go up because the fundamentals inflect positively, thereby unlocking that value. The fundamentals become a catalyst to unlock that cheap valuation. And so by definition, that means that stock is no longer a value stock. It's actually now a growth stock. So it's growth that works all the time. It's not value working because it's cheap, right? And so in other words, the stocks that are cheap, that don't inflect higher and trend higher, are what we call value traps. And the reason they're value traps is because there's no fundamental catalyst to unlock the value.
Yeah, no, I think most businesses are that are low multiple businesses are low multiple or trade at low multiple because they're crappy businesses. I mean,
yeah.
And they're in a competitive space. They have no pricing power, any number of reasons. But over time, share prices are generally going to follow earnings per share.
Right.
And so if you can find something where that's not adequately discounted in the current valuation, that's where you end up generating the alpha and making a lot of money.
Right.
But stocks tend to also follow marginal returns or incremental returns on invested capital. And so that's why you're seeing now all of these ARC names that have these high growing things with no returns actually on invested capital. Yeah. Going down when things with, capital intensive businesses in an inflationary environment, those marginal returns on capital are going through the roof, mm-hmm. right? And they're not really investing anymore. A lot of them are not drilling all that much for talking about oil. And so that's kind of what's the dynamic is right now in the current regime.
Right. And so in that regard, do you tend to find that your fundamental process works better in a certain, because one of the great things about technicals is it's fungible. You can use almost the same exact strategy across asset classes, across time frames, across regions. You name it. It's trend following. If it's a price, it'll trend, and you can use the same tools. Fundamentals is different, right? You can't use the same valuation metrics even from sector to sector. That's very different. You certainly can't. You can't use the same fundamental techniques to analyze a company as you can to analyze soybeans, right? But you can do that with technicals. So I'm curious. Do you find that your process, the way you execute it on the fundamental side, tends to work better in certain sectors, or is it pretty pliable?
It tends to work better in stuff that I know well, I think.
Yeah.
So it comes down to circle of competence and what you know and don't and understand and don't. And I think that's where it works the best.
Right. Stick to your knitting.
Yeah.
Yeah. So your portfolio, if I think you said is concentrated, and what I find is, and Frank again would corroborate this, but the investors love the idea of concentrated, eclectic, uncorrelated. They love all of that until it's eclectic and uncorrelated, right? They love the idea until it's actually, until you deliver it. So we've struggled with that over the years. And so my question for you is, you have a benchmark, you have a public mutual fund, you have a benchmark that it's benchmarked to and compared to. What are some of the mental tools you use to help yourself personally? Because this is a very tough thing to do. That's why I took a year off. It's very tough to do. It's draining. At least I find it is. Maybe your answer will be different. But what are some of the mental strategies you use personally to help yourself navigate the windows of time where you have your bets, you have your conviction, and you're just really deviating from the benchmark, and you're getting, to use a phrase from earlier, you're getting your face beat in? How do you deal with that mentally for yourself? And then we'll talk about how you deal with it for clients, because that's even more important.
I go and take the CMT exam.
Yeah.
So that's what led me to it.
Yeah, I like that, yeah.
No, I think it's understanding why, having a good understanding of why you're underperforming. The worst is when you sit there and you go, why am I, and you can't understand that.
Exactly
Then you got a real problem.
Yeah.
If you understand why you're underperforming, you understand the conditions that would cause that to reverse, and what you're betting on and what's likely to happen in the future, you can get more comfortable with it.
Right. And how about clients? Because at the end of the day, I think your answer was perfect. Not that I'm grading your answers, but I think that was exactly that's certainly how I think about it as well. But where we've struggled is trying to get that same level of conviction and understanding at the client level, because at the end of the day, you can have a great idea, but if the client comes in at the highs and leaves at the lows, that doesn't help anybody. I think somebody mentioned that Peter Lynch's track record was, George, Peter Lynch was 29%, but the average shareholder was 10%. Yeah, and that's because of their buying the high and selling low. So, and I always, the more I've been in this business, the more I've kind of felt like the onus is on the manager, the portfolio manager, to properly educate and communicate with their clients and tell them and help educate them as to what to expect. As you said, this is what happened, this is how we're underperforming, but we understand why. And so therefore, that's why I, as a shareholder, am adding to the position. That kind of thing. So do you proactively, I know it's a mutual fund, so it's a little hard to do this, but is there a way that you can communicate to your clients and help coach them through these very difficult, but at the end of the day, very rewarding, if you pull it off properly, these periods?
Yeah, absolutely. They need to know what's going on. They need to understand the strategy going in. And I think we've had a pretty good track record on the actual shareholder redemptions or lack thereof. I think part of the problem too is that mutual funds I don't want to say it's a dying wrapper, but it is. And so it's important to actually, one of the lessons I remember from business school is getting a growing city. If you're in real estate, you want to be in a growing city. You want to have that growth. And so mutual fund wrapper is not ideal from that perspective, but and it's also not ideal from a communications perspective. I think now you're actually in a really interesting point in the investment management landscape, in that you can actually have products with daily transparency where you can communicate with shareholders directly live, and nobody's really doing that well, and I think we're going to eventually do that.
Yeah.
But yeah, clients absolutely need to be informed of the bets you're making, the overall rationale behind the strategy, and when it's likely to be volatile, and when it's we're pretty explicit when we're likely to underperform the benchmark and when we're likely to do well. And I think people get that.
Yeah, and the idea is to coach them on that before it happens.
Yes, right? Exactly.
Yeah. So let me see. I had some more questions for you on the portfolio, but I know we have limited time, and I want to save some time for questions here in the audience. So let's maybe move to current outlook. And I know, obviously, we just had a brief discussion on cryptocurrency and whatnot. I know that Warren Buffett and Charlie Munger are very anti the weapons of mass destruction for financial wealth, and then we have Elon Musk, who's all in, at least for now, who knows. But so we have these very smart, very successful people who have looked at the same data. Mm-hmm. They've probably spoken to the same experts, but they come away from it with a very different conclusion, which is, thankfully, that's why I'm a one of the main reasons I'm a trend follower is because I let the market figure that stuff out for me, and we just heard somebody say that the best way to invest in crypto is using technicals, because at the end of the day, trend is trend and all that, but we do have these smart people that weigh in with completely juxtaposed viewpoints. And I know you and your dad are I wouldn't say all in on crypto, but I know you believe in it. So maybe give us a quick synopsis as to what you're thinking about it and why you believe in it.
Yeah, so we've been buying steadily since 2013, Bitcoin. I kind of got interested in it just from reading about it in the paper and just saying this is a unique, weird little idea. The thing's super volatile. Let's take a look and see what this is about. And then when you actually dig into the white paper and understand that it is actually a technological innovation. So you mentioned earlier how people sit here or look at it from different angles, and you get a lot of smart people saying, oh, this is garbage. What the heck is this? Doesn't make any sense. This is rat poison squared, whatever. The reality is it's a new technology in that you can transact with anyone anywhere in the world without any centralized authority. You don't need government to bless it. There are ways around that when you actually look at how the protocol works. Not that you need to be around it, because if you look at the White House white paper, whatever, the executive order that came out a couple weeks ago, they said we want to be a leader in regulating this stuff. Not we want to shut it down, we want to be a leader in allowing this innovation to occur. So there goes your legal, it could get banned one day, bear case. Although I think that was out the window long before that when they started auctioning Bitcoin to US citizens I think they've auctioned something like 25 or $50 billion worth of Bitcoin to the general public. So you can't do that and then go ban it. I mean, that would just be strange, I think. But again, it's a technological innovation that hasn't existed before because it's Bitcoin is different than crypto. I want to make that point extensively.
I was going to ask you this.
So they're entirely different technologies when you look at the consensus mechanism, and that's why institutions are moving into Bitcoin and not moving into all these other things. Right. So it is a technological innovation. It's supposedly impossible to value, but it's not at all, because there's a lot of frameworks you can use to think about it. And I wrote a piece called The Value Investor's Case for Bitcoin in 2015. It's on our website now.
It reminds me of your dad constantly having to defend his value definition for Amazon, right?
Right.
In the 90s.
Yeah, well, to that point, what's really interesting is that all things that have massive right tails on them,
yeah, exactly.
Every single one of them has people going, this doesn't make any sense. This is silly. This is stupid. If you can sell books on the internet, So, I mean, we're also invested in a really cool thing personally called Big League Advance. It's run by my friend Michael Schwimmer. And so this is financial innovation. Everyone thinks they're going to do a startup and it has to be an online thing. This is financial innovation at its best. He was a pitcher for the Phillies and the Blue Jays, and he realized that when he was in the minors, he's playing with these guys making $11,000 a year, and a lot of them are eventually going to make $30 million a year. And there's an interesting arbitrage opportunity there, right? In that you can create effectively a venture capital fund and get the guys who you think are going to be the best players. He came up with all this around the time Moneyball was coming out, working on stats and all these other things. And he came up with this idea, and he took it to a ton of investors. It was pretty much all no's. So we were personally the anchor investor in this thing.
And what's it called again?
Big League Advance.
Big League Advance.
He's now on his third fund. Every single one is like, his third one's been oversubscribed. He raised money like that, right? And so it's income share agreements with minor league players. He, did the models on OPS and who's going to do well, and ended up doing deals with a bunch of guys. And that fund is performing incredibly well. It's uncorrelated with anything else. And so that's really cool financial innovation. My point on that is everyone he took it to, except individual investors who do weird things, were like, absolutely not. This doesn't fit into this bucket. This is weird. And so things, generally speaking, that fit those categories often tend to be the things with the right tails. The world is governed by fat tail events, and people underestimate how often those can happen. And one of the things that also is super interesting about Bitcoin for this particular audience, I'm surprised that more people are not into it, just because the technical data that you can get on the blockchain is unsurpassed relative to stocks and bonds and other stuff like that. So you can get, if you mind, there's data being produced 24/7, number of wallets being created, realized price of every single coin on the blockchain, all kinds of information out there that you just can't get in stocks and bonds, and that data, I think, is ripe for potential people that want to be active managers of Bitcoin. I think it's an interesting intellectual exercise. Can you outperform Bitcoin using technical analysis?
Yes.
I don't know. I think probably.
Yes, the answer is yes.
Yeah.
We have Jay-Z Peretz was, I think it was episode 16 guest on the podcast, and he did a great deep dive on that. What I'm excited to see coming out of his company is if he eventually releases it to the public and make it more broadly available, is he's doing all kinds of like breadth work and index development and things like that. That's basically taking the same tools we've used for several generations in the technical community and using them to make similar assessments of the blockchain. Not blockchain, but digital currency space.
Yeah.
So it should be very transferable. But the idea is that, if I understand, is that one of my concerns about digital currency overall is that it just struck me as being very, very similar to all of the IPOs that came out surrounding the internet from, say, like 95 to 2000, where we had all these companies that came out that would just put a .com at the end of their name, and there were many things where they really didn't have a defined business plan, very similar to the SPACs of today, and there were hundreds of them came out just before the bubble took off, and then we now know that that's a cemetery now of all those former companies. Today, when you look at the most of the charts of, I look at probably four or so hundred digital currency charts in my weekly chart review, and almost all of them start in 2000. Very reminiscent of how these things happen, where you just get this flush of IPOs, and then the thing takes off, and then everything. And so far, the evidence seems to be pointing to these things are washing out. Now, we also know out of the bubble in 2000, we also know that all played out. Most of those companies went out of business, but we do now have Amazon, right? Apple survived, and we now have Apple. So somewhere in there is an Amazon. Maybe it's Bitcoin, but do you see a similar fate for most of those other currencies, where they're just like sock puppets? And
yeah, I think it could be even worse than that. They may eventually be ruled unregulated securities offerings. Who knows? Now, Gensler has said that Bitcoin is not an unregulated securities offering. Again, it goes back to the consensus mechanism and the way transactions are verified. But and again, the impetus of it. For Bitcoin, there's no head of the snake to cut off. There is no centralized authority. It's entirely decentralized. And if you think about the history of fiat currencies over long periods of time, they have all failed. Right? And if you think about the relevance of government over time, that is also going down. And so you could see this being a multi-decade sort of interesting trend.
Do you think the prospect for regulation, though, would undermine all those values that people point to in digital FX? I
think regulation is a good thing. I also think owning some self-custodied Bitcoin is a good thing. For that reason, but regulation is a good thing because it brings additional clarity to the space. Yeah,
interesting. Let's talk maybe about the Fed a little bit.
Sure.
So we had some great discussions yesterday with John Roque and George Noble and Jim Bianco talking about regime change. We see it in the charts all over the place. I mean, it seems pretty clear that these are pretty violent changes. We see what's happening with the yen. The FANG stocks are blowing up one by one. There's a lot going on around the world, and it all seems to be pointing to a regime change of some sort. And so, from a technician's perspective, all we do is let the market figure that out. The way I like to say it is that we hire the market to do the fundamental analysis for us. It's proven itself to be a pretty good fundamental analyst over time. That's why it's so hard to beat. So that's our shtick. We just check our opinion at the door and just follow trend. I'm curious, from your perspective, where you're not that devout of a technician, you come to this from a fundamental perspective, and you're seeing all these things happen technically. Can you see the fundamentals coming together with the chart? What's what you're seeing at the chart level, or are you still trying to figure it out? Do you think there's a regime change?
I do think there's been a regime change.
Yeah.
I think the regime change started when the Fed changed their reaction function a year or two ago, and they said they're going to let inflation run hot. Because prior to that, it was a quote-unquote symmetric goal of 2%. It wasn't symmetric at all. What happened was they kept raising rates anytime the CPI got even close to 2%. And it was between 0 and 2. Anytime it got 1.92, or start raising. And so that's a problem because you have capital allocators across the country, whether they're talking about CFOs or anyone else, building the symmetrical level of 2 into their models, and that capital is not, it effectively means it's been misallocated if you don't have that level of inflation over time. And so then they kind of realized that as we were getting close to zero and going into this kind of vortex towards zero, the only way out is to get a little inflation. And now they're so far behind the curve on the other side, it's that's why value is ripping. And they're still very far behind the curve. Now they're talking 75 and inflation's at 8. So to actually get ahead of the curve, they need to do something the market is not expecting. And the levels just aren't there right now. So that's the real concern, I think.
Right. And so it seems to be the common belief in those halls that it's more difficult to incite inflation than it is to stop it. So, which I always found interesting that was their belief, but then why were you so worried about it going above 2%? But that was their modus operandi. That's how they did it. But here we are today, and we're now seeing the highest month-on-month or year-on-year inflation, in 20 years, maybe 40 years. And the question is, do you actually think that they can stop it, like put the genie back in the bottle?
I don't know at this point. They have to do something drastic, and they have to do it now. They have to do it yesterday. So I don't know. It'll be interesting to see what happens. The Goldilocks thing, I'm talking about that yesterday. Goldilocks is dead. That's probably right. It's just how long is this regime going to last? You are seeing some interesting corrections on valuation on the other side of things, right?
Mm-hmm,
you've never been able to buy, I don't think, Amazon at 14 or 15 times next year's EBITDA. That's interesting.
Yeah, I just always, I remember, I see that and I understand that, but I also remember back when Dell peaked and it was finally cheap, and then it just went down 90%. Right. So that's why valuation is just not a good timing tool in either direction. But I do want to ask you that if indeed we are inflecting toward an inflationary environment, I think, okay, inflation, that means inflation expectations go higher, which means rates go higher, whatever that yield is, whatever that instrument that it's on, the price of it goes down to drive the. Mm-hmm. So you're an income investor. How are you dealing with that? Because that implies that you might be for some tough road.
Yeah. No, we're doing stuff like owning Indo unsecured debt at a 20% yield that we think is worth par. We're doing stuff like Chemwars is one of our largest positions. CC is the ticker there. It's a 3%-ish yield, pricing power, operating leverage, phenomenal allocator of capital, serial share repurchaser, good management team, stuff like that. So you're looking for yield in alternative ways where the yield is a value type of yield, and where in a rising rate environment you're likely to see the residual cash flow that you're entitled to grow. So that's how you try and deal with it.
And just stick through to the maturity to get the.
In some case, well, so let's say something, we bought PBF Energy bonds at like 75 or 80 cents on the dollar. I think they're now 95, and they yield 7 or 8. We may not stick around until par on that one, maybe, but it's, we wait until things are fairly valued and then sell and look for other stuff to rotate it into that may not be fairly priced.
Is there anything more recently that's kind of checked the boxes for you in this regime that you haven't owned up until now that you're pretty excited about, whether it be a stock or a sector or asset class or?
Anything I'm really excited about now?
It could be puts. One. I mean, puts are fine.
No, it's everything's a one-off, bottom-up kind of basis, and then what you try and do is you manage the aggregate risk at the portfolio level, and so. We invested in, we had owned some Russian securities for a couple of years, which are currently marked at 0. The market's telling you they're not going to end up being worth 0, but either way, we knew our risk Russia going in this year was 3% of the portfolio. Okay, if that goes to 0, you're down 300 bips. And so that's the kind of thing where, but you're still not down and out when you look at kind of our tracking error or volatility relative to the benchmark and what we can do in short periods of time versus it. So,
right. Do you take any measures to hedge out foreign exchange exposure?
No, hedging is a cost, I think, and so. But you need to have a fundamental view on the currency, I think, when you buy stuff like that. So for us, Russia was actually a somewhat of an oil energy, right?
Yeah.
And so that didn't work out, obviously. But you need to have a view on the currency and what will make it move in your favor or not.
Right. Okay. I have one more question, so I don't know if you want to. Do you have questions online as well, Bill? Yeah, okay. So let's end with something a little more fun. Not that this hasn't been fun, right? But so what do you do for fun? What do you like to do? And you can say markets, that's fine too.
I do, no, yeah, markets is a lot of it.
Do you feel like you work for a living?
No,
Yeah.
not at all.
Yeah, I don't either.
Yeah.
Because I don't. But
No, that's exactly right. It beats working every day.
it does beat working every day.
I'm trying to take up golf. I love that it's quantitative. I love that it's personal. You don't need anyone else to do it. Do it on your own time. Get better watching YouTube.
Yeah.
It's pretty cool.
Yeah, good stuff. All right, so let's open it up for some questions. Thank you very much, Bill Four. That was a wonderful discussion. I really appreciate it.
Thank you.
Got one right back here from Brett Viome, president of the CMT Association.
Hi. Thanks for sharing your comments with us, Bill. I really appreciate it. And great job, Dave. Thanks for doing this. My question was, you kicked off your comments today by saying that you pay attention to insider transactions. And during my career, I spent many years trying to incorporate insider transactions in my analysis. And then I sort of had the rare experience of being inside of a publicly traded company where I used TA to help advise the executives about timing their sales. And so I kind of learned that most executives, including board members and executive officers, have these compensation structures that reward them in incentive comp with shares, unlike their outright sales, which there is no real structure to. So I wanted to see if you would elaborate a little bit more on how you view insider transactions.
Yeah, you made a great point there on the sales front. We pay a lot less attention to insider sales than we would buys. There's a lot of reasons people would sell something, and there's generally only reason people would make a sizable purchase in something because they think it's mispriced or cheap and they want more of it. The context matters immensely on the insider side of things, and I think probably if you run an aggregate analysis of these things, it may not, may be hard to incorporate it. You need to look, the context matters. So who's doing the buy? Is the buy significant to them personally? Maybe not. Is it just a virtue signal? Is it, self-flagellation for poor behavior? Is it, or is it actually, is it actually cheap? And so all the context goes into that. Corporate strategy goes into that. Capital allocation goes into that. And everything is context dependent. But you're looking at the track record of the person doing the buy. You're looking at the overall company strategy. And so the context does matter.
Hi, thanks for your comments today. The one question I have is if you took a Bitcoin currency, and today we have the Fed with a lot more control, so when you have something that's decentralized like a crypto, how do we prevent market crashes, and what tools would we be able to employ if everything's decentralized and not in government control?
It's a great question. Yeah, well, so there's puts and takes to it, right? In that the scenario you're envisioning is effectively hyper-Bitcoinization, where everything is, Bitcoin is the global currency, right? I don't think that's necessarily the only outcome. I think, could be a hybrid where there's the dollar, there's Bitcoin, there's the yen, there's the euro, and maybe that's it.
Could it be a digital dollar?
Yeah, I think they want there to be a digital dollar. I think there's all kinds of major issues with that, just ethically and other stuff. But yeah, so that's a really good point, in that if there is hyper-Bitcoinization, the offset to that, not having these escape valves that you mentioned, is that if everyone knows the rules ahead of time, and that's why I like Bitcoin, is that you know the rules ahead of time. You know exactly how many Bitcoin are going to exist. You know exactly what that's going to look like. And if people mess up, they mess up, and you deal with the consequences. But hyper-Bitcoinization, I don't think, is necessarily the only outcome. The other interesting thing is that, if it actually ends up that is the method by which we transact, number one, volatility will be much, much lower in that circumstance just because of broader adoption, other things. But sorry, where was I in this? I just lost my train of thought.
I'll let you get it back, but the only thing I would say to that is that some of the most violent crashes have happened because of the regulations
Yeah,
that have been
that's
put in place. And like, was the SEC was 1914? Was when the SEC was, well, no, not the SEC, but the Federal Reserve was 1913. And some of the most egregious bubbles have happened since the Federal Reserve was put in place. So it'd be nice to think that a regulatory body like that would be able to corral and contain and make things better. But in actuality, as Master Uguay said, one often meets his destiny on the path he travels to avoid it.
Yeah, so the offset to that is that people's behavior will improve just because of the fact that you have a currency that doesn't lose its value over time, I think, right? And that you have this immutable protocol where there's 21 million coins exclusively, you know exactly how many are mined. You don't have inflation. The reason inflation exists is because of policy missteps at the fiscal level. And so those policy missteps, you don't have the inflation if you have a Bitcoin, which actually has appreciated significantly, biggest trend of the past 12, 13 years. So that is an offset, is that it matches people's behavior. You want to save your money. If you're not investing in stuff that's going to go up faster than this rate of mistakes in the government, you can just it sits in Bitcoin, you don't have that inflation. So hold its purchasing power.
I think that was our last question. Gentlemen, thank you very much for your time today.
Thank you.